Welcome back, ladies and gentlemen, to our next session. I pray and believe that we are all doing well. Great. This is a continuation of our financial accounting class, paper 1.1. Our last session, we're looking at non-current assets and depreciation. We looked at what non-current assets are, and we came across the terminology, various terminologies. Notable among them was the PPE, because we know that assets, as we know, those of us who did accounting in SS, we know that we have something called fixed assets, current assets, among others. Now they are saying we should, the requirements of international accounting standards or international financial reporting standards. We have something called non-current assets or property, plant, and equipment. We know that there are property, plant, and equipment could be tangible or intangible. Okay, and anything that is not current is a non-current asset. Looked at what's a carrying amount, what's a depreciable amount, what's a net realizable value, what is fair value of an asset. Okay, we moved on to look at the recognition of an item of PPE. That is what conditions must be present before an asset could be recognized. Okay, we further look at a component of cost, a component of what constitutes the cost of an item of PPE. Move ahead to look at the various methods of calculating depreciation. Okay, we learned about the straight line method, we learned about the reducing balance method. We did come to also establish that as an asset is recognized, it is initially recognized at cost, and subsequently, the organization can decide to keep the assets at cost or to revalue it. We looked at the various details of revaluation of an asset, what to look out for when an asset is revalued, and how to account for the differences that may arise in the value of the assets. Okay, and we looked at how to change the carrying amount of a revalued asset. Okay, and we looked at some work examples and exam type questions. Great. Now today we are continuing our discussion from depreciation of a revalued asset. Depreciation of a revalued asset. That is, now after a non-current asset has been revalued, depreciation charges are based on the new valuation. So if you have an asset and the asset is revalued, now the old costs with its estimated useful life are revised when the asset is revalued. So the asset's revalued amount becomes the cost. Okay, and we look at that new revalued amount or the revalued amount. Okay, what is the expected useful life of that asset after the revaluation? Good. So that takes us to what is termed as revision of useful lives and residual values. Now, useful life and residual value should be reviewed at the end of each reporting period and revised if expenditures are significantly different from previous estimates. So again, if an organization has adopted international financial reporting standards, there's a requirement under IAS 16 that the useful lives and residual values of the assets should be reviewed at the end of each reporting period to find out whether expectations have significantly changed from the previous estimates. So assuming you have an asset, and right on acquisition, you estimated that the asset will be used for 5 years. Now, you need to monitor the condition in which the asset is in to find out whether the 5 years that you estimated is indeed appropriate. Okay, appropriate in the sense that if there is a need for revision of that asset's useful life, you have to make sure that the company benefits from the continual use of the assets. Good. Now, the carrying amount of the assets at the date of revision, less residual value, should be depreciated over the revised remaining useful life. So when you carry out an assessment, when you review, and you think that, well, the assets can now go beyond the previous estimated useful life, there's a need for you to revise it. It could also be possible that the initial estimate may be too much, and therefore there is a need for a revision downwards. You need to carry out that assessment, and you have to look at the asset's physical condition, the shape in which it is, and the possibility of it going beyond the initial estimated useful life. Or if it could not travel the useful life that we initially estimated, then there is a need for that revision. Good. So let's look at that. Now let's take an example. Let's take an example how to revise the useful life of an asset. Now, an asset was purchased for 100,000 on 1st January 2015, and straight line depreciation of 20,000 per annum is being charged. That is 5-year life, no residual value. The annual review of the asset's lives is undertaken, and for this particular asset, the remaining useful life as at 1st January 2017 is 8 years. The financial statement for the year ended 31st December 2020 are being prepared. What is the depreciation charge for the year ended 31st December 2017? What is the depreciation charge for the year ended 31st December 2017? Good. So an asset was purchased for 100,000 on 1st January 2015, and the straight line depreciation of 20,000 per annum is being charged. That is 5 years. The annual review of the asset's life is undertaken, and for this particular asset, the remaining life as at 1st January 2017 is what? 8 years. Okay, good. So now, let's look at how this will work out. Now we have to determine the depreciation charge for the okay. So let's see. The assets cost 100,000 Ghana cedis, and it was acquired on 1st January 2015. And the depreciation of 20,000 Ghana cedi per annum is charged. Okay, good. So now, let's determine, whenever there is a change in the useful life of the assets, you need to find out what is the carrying amount, okay, of the assets as of the time of revision, okay? What's the carrying amount? So now the asset cost is what? So let's see the cost of the assets. Cost of assets, it costs 100,000. Okay. Then let's look at the annual depreciation charge. Annual depreciation charge is equal to 20,000. Good. So if the annual depreciation charge is 20,000, okay, let's determine the carrying amount. So carrying amount, carrying amount. Let's determine the carrying amount. The carrying amount as at 1st of January 2017. So costs. All right. So the cost of the asset is 100,000. So let's look at the accumulated depreciation. The accumulated depreciation. Now we are looking at the value as of 1st January 2017. So the asset was acquired in 2015. So 2015, 2016, right? 2 years. And the annual charge is 20,000. So 20,000 times 2 will give us the accumulated depreciation for the year ended 31st December 2016, which is invariably the same as the accumulated depreciation as of 1st January 2017. Good. So this gives us 40,000. This gives us 40,000. So this 40,000, when deducted from the cost, we get what? 60,000. So this becomes the carrying amount, the carrying amount of the asset as of the date of the revision. Good. Now, what it then means is that this amount of 60,000 is the new cost of the assets as of 1st January 2017. And we are being told that the annual review of the assets lives is undertaken for this particular assets. The remaining useful life as of 1st January 2017 is what? 8 years. Okay, so here, what it then means is that from as of 1st January, so the remaining useful life as at 1st of January 2017 is equal to what? 8 years. Okay, though it has a 5-year life initially when it was acquired. Now we are saying its remaining useful life is what? 8 years. What it then means is that this asset, okay, this asset could be used for what? 10 years. Because initial it was 5, 2 years is already gone. And now we are saying that as of 1st January, the remaining life of that asset is 8 years. So if 2 years has already been spent or the asset has already been used for 8 years, and now you are saying that as of 1st January, the asset's remaining life is 8 years, it means that the assets could be used for a total of how many years? 10 years. You get a point. Good. However, that 2 years that the asset has been used, that is gone. Because now the asset's carrying value is 60. So now you take the new carrying amount as the cost of the asset and you start your depreciation on a fresh note. So now you have a remaining life of asset as of 1st January to be 8 years, and the carrying amount of the asset as of 1st January 2017 is also 60,000. So your depreciation charge for 2017. So therefore, the depreciation charge for 2017 is equals to 60,000 divided by what? 8 years. And that gives us 60 divided by 8 years. That gives us 7,500. 7,500. Okay, 7,500. So the depreciation charge for 2017 will be 7,500. Good, good. I hope it's understood. Good. Now let's look at this one. Example 2. Example 2. Good. One Touch Limited owns an asset. One Touch Limited owns an asset with an original cost of 400,000 on 1st January 2010. On acquisition, management determined that the useful life was 10 years and the residual value would be 40,000. The asset is now 8 years old, and during this time, there have been no revisions to the assessed residual value. At the end of year 8, management reviewed the useful life and residual value and has determined that the useful life can be extended to 12 years. In view of the maintenance program adopted by the company, as a result, the residual value will reduce to 20,000 Ghana cedis. Okay, good. Prepare the income statement extracts for the year ended 31st December 2018. Good. So the assets Okay, so let's look at the details of the question. So here we have One Touch Limited. One Touch Limited. Good. So we have the cost of assets, $100,000. Date of acquisition, January 1st, 2010. Estimated useful life, initial estimated useful life. Initial estimated useful life is 10 years. Residual value, is 40,000 Ghana cedis. Good. Now we are saying that the asset is now 8 years old, and during this time there have been no revisions to the assessed residual value. At the end of year 8, Management has reviewed the useful life and the residual value and has determined that the useful life can be extended to 12 years in view of the maintenance program that when it comes as a result, the residual value will reduce to 20,000. All right. So let's see. Now let's determine the carrying amount of the assets at the end of the 8th year. So the asset was acquired in 2010. So 2010, 1st January. So 2010, 11, 12, 13, 14, 15, 16, 17. So it means that the 8 years will end on 31st December 2017. Good. Good. So let's determine the annual depreciation charge. Okay, so let me do determination of the carrying amount, the carrying amount as at 31st of December 2017. Okay, good. So the cost of the assets is 100,000. Accumulated depreciation. Okay, that will be equal to 400,000. Accumulated depreciation. Accumulated depreciation will be computed as the cost of the assets, which is 400,000, minus the residual value at the time of 40,000, all over what? 10. Okay, times 8 years. Okay, so we have 400,000 minus 40,000 divided by 10 times 8. That gives us, sorry, this is 400,000. That gives us 288. That gives us 288,000. So 400 minus 40 divided by 10 times 8, 288. So 400,000 minus 288 gives us 112. 112. So that's the carrying amount. That's the carrying amount. Good. Now let's look at the remaining useful life. Good. Remaining useful life. So now we have the extended useful life to be what? 12. Then expired useful life is what? 8. Okay, so when you take the expired useful life from the extended, we get the remaining useful life to be what? 4. Okay, good. To be 4. Now, if the extended useful life is 12 and already 8 is gone, it means that the assets can now be used for what? 4 more what? Years. I hope you're together. Good, because we are told that uh, the asset is now 8 years old, and during this time there has not been any revision to assess residual value. At the end of the 8 years, management has reviewed the useful life and the residual value and has determined that the useful life can be extended to 12 years. Don't forget the initial assessment was what, 10. So it can be extended to 12. It means that the assets originally, the assessment should have been 12 years, but you made it 10. It means that 2 more. So the extended is 12. And already 8 years has been spent, or the asset has been used for 8 years. So it means that the revised or the remaining life is now what? 4 instead of what? 2 years. Because if it was 10 and 8 years has already been spent, then the asset had 2 years more to go. However, the useful life was extended to what? 12. So if it was extended to 12, it means that 2 more years was added. And if 8 years has already been spent, it means there are 4 years to go. Good. And the revised residual value, the revised residual value is also what? 20,000 instead of 40. Good. Now we have to do an income statement extra for the year ended December 2018. Now for the non-current asset, the only portion that reflects in the income statement is the what? The depreciation on the assets. Or if the assets had been disposed and there's any other gain from the asset, then you can capture the other income. Okay, good. But this asset has not been disposed, and so the only portion or the only thing in relation to this asset that could be captured in the income statement is the depreciation on that what assets. Good. So let's look at it. So now it means that as at 1st January 2018, we have cost of assets to be equal to 112,000 to be equal to 112,000. 112,000. We have the remaining useful life. Useful life to be equal to 4 years. Okay. Good. Good. So as of 1st January As of 1st January 2018, we have the cost of the assets, we have the useful life, and we have the residual value. The residual value also equals to 20. Good. So the income statement extracts, income statement extracts, income statement extracts for the year ended 31st of December 2018 will be depreciation, which will be 112,000 minus 20,000, all divided by 4 years. Okay. So we have 112,000 minus 20,000 divided by 4 years, which gives us 23,000 Ghana cedis. Okay, we give us 23,000 Ghana cedis. Good. So this would be a depreciation charge, or that would be the income statement extract. Okay, and the income statement extract, you're looking at the either income or expense. Now, the asset as an asset is used. The asset must be the cost must be spread over the useful life. Okay, and so it's the depreciation portion of the asset that comes here because the asset has not been sold, so there's no income. I'll be together. Okay, so the only thing that we recognize is the income, the depreciation on the assets, and this is how we go about it. Good. I'll be together. Wonderful. Wonderful. Let's continue. Let's continue. Great. Great. Now let's move on to change in method of depreciation. Change in method of depreciation. Now, depreciation method used should reflect as fairly as possible the pattern in which the asset's economic benefits are consumed by the entity. Possible methods include straight line, reducing balance, machine hours. Now, a change from one method of providing depreciation to another is permissible only on the grounds that the new method will give a fairer presentation of the results and of the financial position. Does not constitute a change of accounting policy, but rather it's a change in accounting estimates. Okay, that's a demonstration of how the assets economic benefits is being consumed. So we are saying that yes, there are various methods of depreciation to be adopted. Okay, and one can switch in between. However, the switching in between is only permissible, or it's only permissible, one, on the grounds that the new method will give a fairer presentation of the results and of the financial position of the entity. And again, the change does not constitute a change in accounting policy, but rather it's a change in accounting estimates. Okay, good. Now, later in our discussion, we'll look at what is an accounting policy and what is an accounting estimate. Okay, good. What's an accounting estimate? We'll look at these two differentiation. Good. So let's look at this question. The current amount should be written off over the remaining useful life, commencing with the period in which the change is made. ABC Company acquired a garri processing machine in January 2016 for an amount of 30,000 and adopted a depreciation policy of 20% per annum on straight line basis. The expected output of the machine was estimated as follows. 2016, 2017, 2018, 2019, 2020. Good. At the commencement of 2018 financial year, the directors realized that using product units as a basis of depreciation will result in a more appropriate presentation than the straight line. They therefore changed the depreciation policy from straight line to production units. Prepare the relevant extracts in 2018 income statement and statement of financial position. Good. So initially, the policy was to depreciate this assets, the Gary processing machine, which costed 30,000 over a period of 5 years. That is 20%. So 100 divided by 20 gives us 5. So they would have depreciated this asset over what? 5 years. Good. And within the 5 years, these are the production units. These are the quantities of Gary that the machine can process. Okay, good, good. So in 2018, that is when they decided to go for the production unit method of computing the depreciation. Okay, good. So here, what you should do is to find out the current amount of the asset as of 31st December 2017. Is that not it? Because asset was acquired in 2016, so 16, 17 will give us the accumulated depreciation as of 2017 on the straight line method, which was the initial basis of computing the depreciation, which was on straight line basis. Okay, good. Because it was at the commencement of 2018, so we must determine what the current value of the asset was as of 1st January 2018. Okay, then afterwards, the current value as of December 2017 becomes the cost as of 1st January 2018. Then we take it from there. You get the point? Good. So let's look at it. So this is the workings. The current amount as of 1st January 2018. So the cost is there. Then accumulated depreciation, which is 20% of 30 times 2 years. So that gives us what? 18. Okay, good. Now this 18 is now the new cost of the assets. Okay, so from 2018 going, the cost of the asset is 18. Now we have to use the production unit method. So now you have to look at, okay, from 2018 to 2020, how many units can the machine produce? Now, we have 3,000 for 2018, 2,000 for 2019, and 1,000 for 2020. So that sums up to a total of what? 6,000 units. So we need to divide it by the 6,000 what? Units. 6,000 what? Units. And when we divide it by 6,000 units, the depreciation charge per unit is 3 cedis per unit. The depreciation charge is 3 cedi per unit. So now you ask yourself, in 2018, how many units were produced? Now in 2018, we produced what? 3,000 what? Units. So the depreciation charge for 2018 becomes 3,000 units times 3 Ghana cedis. Okay, good. So you come here, the depreciation expense is 9,000. How did they get the 9,000? The 9,000 was ascertained by what? Multiplying the units produced in 2018 by the depreciation charge per unit, which is what? 3. Okay, and that gives what? 9,000. Up here together. Good. So that becomes the income statement. That will be 9,000. And when you go to the position statement, the balance sheet, it should be what? 18,000 minus 9,000, which will give you what? 9,000. So it's a pretty straightforward. Okay, good. So this is how this question will be handled. Okay, so always when there's a revision, the useful life of the asset, always determine the current amount as of the date of revision. Look out for the remaining useful life and depreciate the current amount as of the date of the revision by the estimated remaining useful life, and you get the current year what? Depreciation. But in this example, there was a change from one method of depreciation to another. Initially, it was a straight line, and they have now decided to use what? Production unit method. So if you are using production unit method, what the depreciation charge is the total cost of the asset over the total production unit over the estimated useful life of the what? The assets. Okay, over the estimated useful life of the assets. Over the estimated useful life of the assets. Okay, good. And then later, you multiply it by the year's production units to get your depreciation for that year. Okay, so in this example, the straight line method was used for 2 years. So you need to determine the current value at the end of the second year. Then from the third year, the current value becomes the cost of the assets on which the production unit method will be used. So you again need to determine the total unit of goods produced from the machine from the third year to the fifth year. Okay, that becomes the total production unit. So the new costs should be divided by the total units that will be produced from the third to fifth year. Then you get a rate of charge per unit. And so when you go to the when you want to determine the depreciation for a particular year, you need to multiply the years. You need to multiply the depreciation charge per unit by the production unit for that year. And so that is what we have looked at here. That's what we have looked at here. Good, 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 good. Now, let's look at separate components of an asset. There are instances where an asset may come with separate parts. And it's important that those separate parts be depreciated over its useful lives. Okay, so a complex asset is an asset that's been thought of as having separate components within a single asset. Example is an engine within a piece of plant. Each separate part of the asset should be depreciated over their useful lives. Okay, good. Good. So where you may be faced with a question of the sort, where there are separate components of a particular asset. Example is also aircraft. They have different parts. Okay, and it's expected that the different parts be depreciated over the useful life. Those parts will last. Okay, good, good. Then there are instances where there are major inspections or overhauls of cost of assets. How do we also treat that? You said that inspection and overhaul costs are generally expensed as they are incurred. Inspection and overhaul costs are generally expensed as they are incurred. They are, however, capitalized as non-current assets to the extent that they satisfy the IAS 16 rules for separate components. Okay, where this is the case, they are then depreciated over their useful lives. Okay, good. So we have an example, and there's an overhaul and especially overhaul costs. We are saying that generally they are expensed. However, they will be capitalized to the extent that they satisfy IAS 16 rules for separate components. That is, those overhaul costs can be thought of as will last for a significant amount of time, or if it qualifies to be a capital expenditure, okay, then we need to capitalize it. Okay, good. Good. Now let's look at the recognition of property, plant, and equipment. The recognition of property, plant, and equipment. Good. Now, the current amount of an item of property, plant, and equipment shall be derecognized. Derecognizing means that removing the item from the books of the entity. Do you get the point? Removing the assets from the books of the entity. Okay, that is derecognition. Derecognition, because we are saying that when an asset is acquired, there's a need for us to recognize it. Recognizing it means introducing it into the books of the company. So if you are de-recognizing it, it means that that asset should be removed from the books of that entity. Good. So we are saying that the carrying amount of an item of property shall be de-recognized. One, on disposal, meaning when an asset is disposed, the asset no longer belongs to the entity, and so there is no need for you to maintain that asset in your books. No, whatever cost of the assets must be taken off your book. Whatever depreciation that you have charged on the asset must be taken off your books because the asset is no longer yours. Good. So an asset may be recognized on disposal or when no future economic benefits are expected from its use or disposal. If a particular asset, there's a clear evidence to the effect that no future economic benefits are expected from its use or disposal, then you must what? Derecognize. So this derecognition of assets can be twofold. One, we are saying that you derecognize it when you dispose it, or when no future economic benefit is expected from its use or what? Disposal. Good. Now let's look at the disposal bits. The disposal bits. Now, gains or losses on disposal of a non-current asset. Now, when an asset is disposed, the company may get a gain or may lose, or they may get a gain or a loss. Okay, good. Now, property, plant, and equipment are eventually disposed of by sale. How they dispose of either by sale, or if they have no sale value, through disposal as what? As scrap. You may dash it off as a scrap. Okay, good. So disposal may be in the form of sale, or if there is no saleable value of the item, then we dispose it off as what? As scrap. Now, disposal can occur at any time and need not be at the end of the asset expected useful life. The effect of disposal on the statement of financial position or accounting equation is that, one, the asset at cost of valuation is no longer in the statement of financial position. So when an asset is sold, the cost of the assets will no longer be found in the statement of financial position as part of the item of what? Property, plant, and equipment. No, it needs to be taken off the what? The books. Good. Again, the accumulated depreciation on the asset is also no longer in the statement of financial what? Position. That's the accumulated depreciation on that asset needs to be what? Taken off the books. Okay, good. Now, the carrying amount of the asset is therefore removed from the accounting what? Equation. There is a gain or loss on disposal of the asset as follows. Okay, good. So when an asset is disposed, now we need to determine the gain or loss on disposal. How do we do that? Now we need to compare the proceeds from sale, okay, the proceeds from sale with the carrying amount of the asset as of the date of what? Disposal. Now the sale proceeds on disposal will be given. Now, if there were any cost incurred in selling the asset, that will also be given. So you need to deduct the cost that you will incur in selling the asset from the sale proceeds to get your net disposal value, or the net proceeds from sale. Then you compare that net proceeds from sale with the carrying amount of the asset. And we know how to determine the carrying amount of an asset. The carrying amount of an asset is given as the cost of the assets less accumulated depreciation. And if there is any impairment loss, we also deduct that one. Now, at our level, we are concentrating on cost less what? The accumulated depreciation. So that will give us the carrying amount. Okay, good. And we compare the carrying amount to the net proceeds. Whatever is left gives us either a gain or what? A loss. Okay, good. Now, accounting for disposal of property, plant, and equipment. Now, in general, in general ledger, the gain or loss on disposal of a non-current asset is recorded in the assets. It's recorded in the disposal of asset account. The double entry transaction required are as follows for assets recorded at cost rather than at a revalued amount. One, if an asset is disposed, one, you have to transfer the cost of that non-current asset from the asset account to the disposal account. So when an asset is disposed, an account is open, termed as what? Asset disposal account. So if the cost of the asset is contained in the asset account or the non-current asset account, we need to take it, because we know when an asset is acquired, okay, it is either paid for or bought on credit. So if the asset is acquired, now we debit the non-current asset account. Is that not it? And we credit either cash or payable account. Okay, good. So if an asset is debited, it means that the asset is increasing in value. Now, if it is being derecognized or if it's being disposed, okay, now it means that that asset must be removed from the non-current asset account. So we credit it. So we credit the asset account. Okay, good. And you go and debit asset disposal account. The next thing is to transfer the accumulated depreciation on the assets from the accumulated depreciation account to the disposal account. Good. Because as the asset is being used, depreciation will be charged on the asset. As the depreciation is being charged, the depreciation is expensed. And since it's a provision being made, the provision is kept in an account called accumulated depreciation account. So the accumulated depreciation account will keep track of all the depreciation that has been charged on a particular asset so far. So if that asset is disposed, that accumulated depreciation needs to be what? Taken off the books. How do we do that? So we go and debit the accumulated depreciation account and go and credit the asset disposal account. Good. So these are the double entry. The double entry. Disposal double entry. Now, we debit the disposal account and credit non-current asset account. That is to transfer the cost of the asset from the non-current asset account to the disposal account. Then again, we will debit accumulated depreciation and credit the disposal account. That is, we trying to determine the carrying amount of the assets. Okay, good. When we do these entries, we are trying to determine the carrying amount of the asset disposed so that we can compare the proceeds from disposal with the carrying amount at the time of disposal. Okay, good. The third thing is to record the disposal cost in the disposal account. That is, if there were any expenses incurred in selling the assets, that also needs to be factored. That's the if there's any expense. We are saying that if there is any expense incurred in disposing the asset, debit the expense and credit bank or payables account. Then we now record the sales proceeds in the disposal account. So now you have to debit the bank account, okay, and credit the asset disposal account, because on receipt of money from the disposal, it will hit either your bank account or the amount will be receivable from a particular data. Then you go and credit the asset disposal account. The balance on the disposal account is a gain or loss on disposal. This is transferred to statement of profit or loss. Good. So let's look at some examples. Let's look at some examples. And that will be it. Good. So let's look at question 1. A machine is bought on 1st January 2008 for 1,000 Ghana cedi, and another one on 1st October 2009 for 1,200. The first machine is sold on 30th June 2010 for 720. The business's financial year ends on 31st December. The machinery is to be depreciated at 10% using the straight line method. Machinery in existence at the end of each year is to be depreciated for full year. No depreciation is to be charged on any machinery disposed of during the year. You are required to prepare the following ledger account: machine account, provision for depreciation account, disposal of machine account, and profit and loss account. Good. So let's look at it. Good. Good. So let's look at it. So here we are to open the machine accounts, open the provision for depreciation accounts, open disposal of machine accounts, and profit or loss accounts. Good. So let's see. Okay, good. So we have the machine accounts. The machine accounts, the provision for depreciation account, that's machine. Okay. We have to open the profits or loss account. Have the disposal of machine account. Okay. Okay. So let's see. Now, in 2018, sorry, 2008, sorry, in 2008, okay, we are being told that an asset was acquired, right? An asset was acquired. So on 1st January, 1st of 1, okay, bank, an asset was acquired for what? 1,000, okay, and another on 1st October 2009. Good. So it means that in the whole of 2008, only one asset was acquired. Is that not it? Good. So that has been recorded. Now we're not asked to open the bank accounts because we know that when an asset is acquired, it's either we pay for it or we buy it on credit. So now I'm assuming that we pay for that separated bank. Good. Now, if an asset is acquired, the asset will be put to use. Is that not it? Good. So at the end of the period, there is a need for us to charge depreciation. Is that not it? Good. Now we're told that the depreciation is charged on what? 10% using the straight line method. Is that not it? Good. So let's see. It means that no other asset was acquired. So at the end of the year, we must close off our asset account. So balance carried down as of 31st December will be what? 1,000. Okay, good, good. Now, at the end of the year, depreciation must be charged. Is that not it? Good, good. So we do our calculation. Now, the depreciation charge is 10% using straight line, and the cost of the asset is 1,000. So the depreciation becomes 1,000 times 10%. Okay, and that gives us 100 Ghana cedis. 100 Ghana cedis. So that 100 Ghana cedis, you know that depreciation is an expense. Is that not it? So we need to debit our P&L and credit our accumulated depreciation account. Is that not it? Good. So when depreciation is charged, we debit depreciation expense account and we credit accumulated depreciation. The depreciation expense account will be found in the profit and loss account. So we come here as of 2008, 2008. Now, 31st, because the depreciation will be charged at the end of the year. We have P&L. Of what? 100. That's accumulated the depreciation. Good. So you come to the P&L account. You come to the P&L account. Because depreciation is an expense, it's debited. Okay. It's debited. So 2008, 31st of December 2008, we have what? Accumulated what? Depreciation. We have accumulated depreciation of what? 100. Okay, sorry, I'm making depreciation. Therefore, depreciation of what? 100. Okay, good, good. Now, at the end of the day, we need to close our accumulated depreciation account because there's no other depreciation charge for that year apart from the depreciation on the first asset apart. So on 31st December, our balance carried down is 100. So we come to 2009. So 1st of January, balance brought forward is 100. Then we come to our asset account as well. In our asset accounts, we have 2009. So 1st of January, balance brought forward is 1,000. Okay, good. Now our P&L account, okay, is there. So for the year ended, that's the income statement. That's what goes in there. Okay, good. Now let's look at the next. The next is that another one on 1st October. Another asset was acquired on 1st October 2009. So 2009, 1st of 10, bank is what? 1,200. Okay, 1,200. Good. So here you can maybe take note of the assets when they come in. Okay, good. So now, the asset was acquired in 2009 for 1,200. There was no other acquisition in 2000 other than the second assets. Okay, so it means at the end of the year, 31st December, our total assets in our books will be what? Will be 2,200. 2,200. So the balance is 2,200. Good. Now, at the end of the year, we must charge depreciation because the assets will be used. Now, don't forget this statement that machinery is depreciated at 10% using straight line method. Machinery in existence at the end of the year is to be depreciated for full year. no depreciation is to be charged on any machinery disposed of during the year. So what it means is that a full year's depreciation is charged in the year of acquisition, but none in the year of disposal. What this policy means is that if the asset is also is even acquired, maybe on 1st of December, and your accounting year ends on 31st December, you will charge full year. But any asset disposed of during the year, even if it is disposed on 31st December, no depreciation will be charged. That's what it means. If the asset even spends 15 days, depending on the policy of the company, if assets are acquired, okay, maybe some days before the end of the month, and they are depreciated, that is fine. For some companies, if an asset is acquired after 15th, that particular month, they will not depreciate it, so it depends. But in this question, the policy is that a full year's depreciation is charged in the year of acquisition, but in the year that a particular asset is disposed, that particular asset will not be depreciated. But if an asset is acquired, say, 1st of December, okay, or maybe 1st October, just like in this question, we are saying that ordinarily we should have prorated the depreciation. The depreciation should be prorated. However, because of the policy of we charging a full year depreciation in the year of acquisition, we will charge a full year depreciation for that asset, as opposed to we prorating the depreciation charge. Good. Now, I'll also advise that anytime you are doing this form of accounting for depreciation, okay, now try and identify each asset and compute the depreciation on each asset separately. Don't lump them and charge, because one asset may be disposed of. Now, when the asset is disposed of, you need to track all the depreciation that you have charged on that asset, okay, and move it out of the accumulated depreciation account. So if you lump it, it becomes very difficult. So it's my advice that anytime that you are confronted with depreciation question or accounting for non-current asset question, and you're having to open this account that we are looking at, don't merge the figures. Identify each asset and depreciate each asset separately. Good. So now, let's continue. At the end of the year, depreciation needs to be charged. So on the machine, on the first machine, that is 31st December, P&L will still be what? 100, because it's on straight line. We divide it over 10,000 over 10 is 100 for 10 years. So we report our 100 Ghana cedis. That's we can say number one. Then 31st December, P&L, number 2. Now the cost of the asset is 1,200. So 1,200 times 10%. Good. That is 120. Good. If we're using 1 month ownership basis, that is, we'll charge depreciation as and when the asset is used. Okay. That one would have charged 3 months. That's October, November, December. So I've been 3 months. That's 1 month ownership basis. But here they said full year's depreciation. If the asset is even used for 1 month, we are saying that charge a year's depreciation. Good. So that becomes what? 120. Okay, good. Now, the first machine is sold on 30th June. Okay, we are not in 2010 yet. Good. So what it means is that for this, we get our total depreciation for 2009, and that becomes 320. That becomes 320. So 31st of December, our balance carried down. So 320. So 2010, 1st of January, balance brought forward is 320. Now, let's look at our profit or loss accounts. So this is for 2009. Okay, as of 31st of December, we have depreciation. Okay, so you can say number 1 is 100. 31st of December, depreciation. Number 2 is 120. Okay, Good. 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 So let's look at 2010. So in 2010, in 2010, in 2010, we have 1st of January balance brought forward is 2,200. Now, was there any acquisition in 2010? No. He said the first machine is sold on 30th June 2010 for 720. The business's financial year ends on the 1st December. The machinery is depreciated at 10% using the straight line method. Machinery in existence code. So now, here in 2010, on 30th of June, okay, the first machine is sold or was sold. Now, it was sold for 720. Now, that is the sales proceeds. That is the sales what proceeds. But we've learned that when an asset is disposed, the cost of the asset must be taken off the books. So here, it is not the sales proceeds that we are going to record in the machine account, but rather the cost of the asset must be what taken off the books. Now, how do we take it off the books? You need to credit the machine account in the name of what? Disposal. Okay, and with what amount? With the cost of that asset disposed. Now, this asset that has been sold was bought for what? 1,000 Ghana cedis. So if it has been disposed, its cost must be taken off the books. So 1,000. Now, we need to then go and what? Debit our machine disposal of machine accounts. So in 2010, as of 30th of June, we have what? Machine of what? 1,000, because we have credited the machine account in the name of disposal. So we need to debit disposal in the name of what? Machine. That is it. So when an asset is disposed, it is not the proceeds that is recorded in the asset account, but rather it is the cost of the asset that is taken off the asset account. Good. So what it means is that at the end of the year, which is 31st December, our balance carried down will be the cost of machine number 2. And there was no other acquisition in 2010. So this is how the account will look like. Good. Now, we learned that no depreciation should be charged on any asset that is what disposed during the year. So it means that for machine number 1, no depreciation will be charged this year. So let's look at our depreciation charge on machine number 2. That's the 1st December. Good. Before that, let's look at something. Now, if an asset is disposed, the cost must be taken off the books. So we have credited the asset account with the cost. Again, whatever depreciation that has been charged on that asset to the date of disposal must also be taken off the books. Good. So here, let's look at the depreciation that have been charged so far on machine number 1. Now this is 1. This is what? 2. So far, 2 years depreciation have been charged because it was acquired in 2008. So 2008, 2009. And 2010 it was disposed. So 2 years depreciation have been charged. And that gives us what? 200. So you come to the accumulated depreciation account, provisional depreciation account, and you come and debit the account. That's 30th June. You debit it in the name of what? Disposal. Debit it in the name of disposal. You can write it bracket machine number 1. And the total accumulated depreciation is what? 200. Because the charge was 100 each year. Good. Then on 31st December, you charge your depreciation P&L on number 2. Good. So machine number 2 costs what? 120. 1,200. So 10% of 1,200 gives us what? The 120. Good. So charge for the year is 120 on machine number 2. Good. Now, then, if the disposal account or if accumulated depreciation has been debited in the name of disposal, then what do we do to disposal? You need to go and credit disposal, right? Credit disposal, that's on 30th June in the name of what? Accumulated depreciation, and that is 200. Okay, good. 200. Good. Now, we are determining when the asset has been disposed, we need to determine the profit or loss on disposal, right? So now, by we debiting the disposal of machine account with the cost of the asset and the accumulated depreciation, what we are doing is finding the carrying value of the asset. We are finding the carrying value of the asset disposed. Good, good. So this is what we have done. Now, when the asset was sold, an amount of 720 was what? Realized. So what do we do? This amount will be debited to our bank account, okay, and credited to the disposal of machine account, okay, because it's an amount that was received in respect of the sale of that asset. Good. So we come here on the same 30th June. We have what? Bank. The amount is what? 720. Okay. Good. So this is the proceeds. Here you can see that in this question, they didn't give us any indication of any cost incurred in realizing this sale value. Okay, good. So you need to determine whether there was a profit or loss made on disposal. How do we do that? We compare the debit side and the credit side. Then whatever difference on the account will be either a profit or loss. So let's see. We bought the asset for 1,000. We depreciated it over 2 years for 200, and we sold it for 720. So this gives us what? 920. Okay, 920. But the asset costed us what? 1,000. So it means that there was a loss on disposal because the cost is more than the sales proceeds and the accumulated depreciation charge so far. Or better still, the asset was worth 800 at the time of disposal. That is 1,000 minus 200. That's the carrying amount at the time of disposal. And we sold it for 720, meaning there's a loss of what? 80 Ghana cedis. Okay, good. So there's a loss of what? 80 Ghana cedis. So that gives us 1,000. 1,000. Am I understood? Good. So whenever there's a disposal of assets, compare the current amount of the assets. So here the current amount is 1,000 minus 200. That gives us 800. So if you don't sell the asset for nothing at all, we should sell it for 800. But rather we sold it for 720. Once it's been sold for 720, meaning we've lost. Okay, good. There's a loss in value by 80. Good. Good. Now let's continue. So we've charged our depreciation on machine number 2. Good. So let's look at the end of 2010. At the end of 2010, this gives us 440. So our balance carried down that is 31st of December. Balance carried down is what? 240. Okay, good. So 440 here. Good. Let's look at our P&L. Our P&L. Our P&L. So this becomes 220. So in 2010, 30th of June, we have the disposal. 80, that's the loss. Then on 31st of December, we have depreciation of 120. So in total, our loss expense for the year comes what? 200. Okay, good. So basically, this is how we go about it. Okay, good, good. Now, assuming there were acquisitions of other assets for the subsequent periods, okay, we would have continued. Would have continued. So now the most important thing was for us to look at how we demonstrate the disposals, okay, how the disposal will be handled, and that has been treated. Okay, that has been treated here. Good, good, good. So even if you continue, there will be nothing new to be just re-depreciating the machine number two for over 10 years. That doesn't make any difference. Okay, good. So this is how we go about the accounting for disposal. Okay, good, 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 good. All right. So let's see. Let's take another question and see how we go about it. Okay, so let's look at question three. Let's look at question three. Great. Now, a business with its financial end on 31st December buys two vans on 1st January 2004. Machine number one for 8,000, number two for 5,000. It also buys another van, number three, on 1st January 2006 for 9,000, and number four on 1st October 2006 for 7,200. The first two vans were sold. Number one for this, number on 30th September, number two for scrap, 50 on June 2008. Depreciation is at the rate of 20% using reducing balance method. You are required to prepare the following account: motor balance account, provision for depreciation, motor balance account, disposal of motor van account, and profits and loss account. All right, so let's look at it quickly. All right. So I have my Autobahn account. My provision for depreciation as motto. Okay. The disposal. So I'm doing my $20. Okay. Okay, so the first machine was bought on 1st January 2004. For this, number two, okay. So on in 2004, 1st of January, bank, 1st of January, bank. So we have number one and number two. Okay. Now number one was 8,000. One was 8,000. Then number 2 is 5,000. Good. First January for 8,000, number 2 for 5,000. Good. So that was what was bought in 2004. So that gives us 13,000. So at the end of the year, 2004, 31st of December, balance carried down be 13,000. 13,000. 13,000. At the end of the year, we must charge our depreciation. Okay, so on 31st of December, we have P&L number 1, then 31st of December, P&L, that's number 2. Okay, good. And here the depreciation charge is 20% using the reducing balance. Good. So we take the first one, 8,000 times 20%. Okay, that's 1,006 for number 1. Number 2 is 5,000 times 20%. That is 1,000. That's 1,000. Okay, good. Good. So at the end of the year, our accumulated depreciation is 2,600. 2,600. So 31st of December, our balance carried down is 2,600. So 2005, 1st of January, our balance brought forward is 2,600. Good. Good. So now we must record the depreciation in the P&L because it will be charged to the profit and loss account at the end of the period. So 2004, on 31st of December, we have depreciation number 1 of 1,600, depreciation number 2 of 1,000, so a total of 2,600 is charged. Okay. Now let's look at 2005. Now in 2005, there were no acquisition. The third and the fourth assets were acquired in 2006. Good. So it means that in 2005, in 2005, 1st of January, our balance brought forward is still 13,000. Okay, good. Now take critical look at this on the reducing balance. So it means that since in 2005 there was no acquisition, it is the same asset that the company was making use of, right? Good. Good. If that is the case, we need to charge the depreciation at the end of the year. Okay, 31st of December. So I have P&L number 1. Good. Now to charge this year's depreciation, you take the cost of the assets. Number 1 is 8,000. You take off the accumulated depreciation, which is 1,600, times the rate of depreciation, which is 20%. So that gives me 1,280. 1,280. Okay, this is my calculator. Good. Now, Now, we do same for number 2. So 31st December, P&L. First December, P&L, number 2. So that is 5,000 minus 1,000. That's 4,000. So 4,000 times 20%. That is what? 800. Okay, chart. Good. So at the end of the year, we have 2,600 plus 1,280 plus 800. That gives me 4,680. 4,680. So on 31st December, our balance carried down is 4,680. Okay. Now at the end of the year, there was no acquisition, there was no disposal in 2005. So 31st December, balance carried down is 13,000. All right. So let's look at P&L. P&L. So come to 2005, 31st December, depreciation number 1 is 1,280. Depreciation number 2 is 800. So a total of 1,280 plus 800, that is 2,080. And the total expense for the period. Good. Good. So now come to 2006. 2006. 2006. So 1st of January, balance brought forward is 13,000. It's 13,000. Okay, good. Now this 13,000, then we're told that number 3 on July 2006 for 9,000, and number 4 on 1st October 2006 for 7,200. So 2006, 1st July, bank, number 3. So number 3 was bought for 9,000. And on the 1st of October, bank, that is number 4, was purchased for 7,200. Okay. The first 2 machines or 2 vans were sold. Number 1 for this one. Good. So 2006, there were only acquisitions, there were no disposals. So we have 13,000 plus 9,000 plus 7,200. That gives us 29,200. 29,200. So as of 31st of December, balance carried down is 29,200. Good. So let's see, 2006, 2006, 1st of Jan, balance brought forward is 4,680. 4,680. Good. So let's look at as of 31st December. Okay. P&L. Machine number 1. So number one is 8,000. We need to take off its accumulated depreciation. So the first one was 1,600. The second one was what, 1,280. So the net, like the current value is now 5,120. Now this one times 20% gives us 1024. Okay, how did we get that? It is the cost, which is 8,000 minus the accumulated depreciation so far, and the accumulated depreciation so far is the charge for 2014 and the charge for 2005, the charge for 2004 and the charge for 2005, which are, so 8,000 minus 1,600, that's the 2004 charge, and 2005 charge was also 1,280. So that gives us a carrying amount of 5,120. Then you multiply it by the rate of depreciation of what? 20%. And that gives us 1024. Good. The same, we do same for machine number 2. Now, machine number two is 5,000. The accumulated depreciation so far good. So you're looking at number 2, 5,000, and the charge so far is 1,000. The accumulated depreciation for 2004 is 1,000, and that of 2005 is 800. So when we take these two out, we get carrying amount of 3,200. Then we multiply it by the 20%. That gives us 640. So we come here, that's 640. Okay, good. Now, in 2006, there were new acquisitions, machine number 3 and machine number 4. Number 3 was acquired on 1st of July, 2006. So we take the cost of the asset is 9,000 times the 20%. Okay, now, in this question, the question is silent as to whether a full year depreciation is charged or not. Now, when the question is silent, we will use 1 month ownership basis or pro rata basis. That is, we will use the time, okay, period to calculate the depreciation. For example, this asset was acquired in July 2006. You cannot say that we will charge a full year's depreciation. No, because the asset was not available for use from January to June of the year. It was just acquired in July 1st of July. So you need to look at the time period. So from July to December, that is what? 6 months. Okay, so July, August, September, October, November, December, 6 months. So we charge 6 months depreciation for this asset because the person didn't say that a full year's depreciation is charged. So where there's no indication of a full year's depreciation is charged in the year of acquisition and not in the year of disposal, you use what? 1 month ownership basis. That is, as and when the asset is used, you charge the depreciation for the period of use. I'll be together. Good. So that is times 20 times 6 divided by 12, and that gives us 900. So 31st December P&L number 3 is 900. Good. So the same 31st P&L number 4. Now machine number 4 came in on 1st of October. So that's October, November, the last 3 months. So that's when we take 7,200 times 20% times 3 divided by 12. And that gives us 360. So we have 4,680 plus 1024 plus 640 plus 900 plus 360. That gives us 7,604. 7,604. So 31st of December, our balance carried down is 7,604. Okay, good. Now let's look at the P&L. Let's look at our P&L. Let's look at our P&L. So we come to our P&L account. So 2006, we have 31st. Good. As of December 31st, 2006, depreciation for number one is 1024. It's 1024. Same 31st December depreciation for number two. Number two was 640. If I'm mistaken. That is 5,000 minus 1,000 minus 800 times 20%. Yeah, that's 640. Now, depreciation, that's number three, was 900. It's 9,000 times 20 times 6 divided by 12. That's 900. And depreciation for number four, which was 7,200 times 20% times 3 divided by 12. That's 360. Great. So at the end of the year, total depreciation charge 1024 plus 640 plus 900 plus 360. That gives us 2924. Good. Good. So let's move on. Good. Good. So in 2007, 1st of January, our balance brought forward is 29,200. Okay. 2007, 1st of January, balance brought forward is 7,604. Good. So they are saying that the first two vans are sold. Number one for 22,290 on 30th September 2007. And number two for scrap for 50 on 30th June 2008. Okay, good. So machine number one was sold on 30th September 2007. Good. So here we need to account for the disposal. So on 30th September We have disposal. That is number one. So number one, it was what is the cost? So in the asset account, you take the cost of that asset out. It is not the sales proceeds. It's not the amount realized from the sale that will be recorded. It's the cost that we are taking off the disposal account. Good. So machine number one has a cost of what? 8,000. It costed 8,000. So you take 8,000 off the books. Okay, good. Now, on 30th on 30th September, okay, you must also take off the accumulated depreciation of that asset. So on 30th September, disposal. But first, we need to charge the depreciation on that asset, because here they didn't tell us that no depreciation is charged in the year of disposal. It means that you must charge depreciation up to the time of disposal. You get the point? The policy is that a full depreciation or a full year's depreciation is charged in the year of acquisition and none in the year of disposal. That is fine. That one, in the year in which the asset is disposed, no depreciation will be charged. But this person is silent. So what it means is that you must charge depreciation up to the time of disposal. So on 30th September, we have P&L, we have machine number one. So the cost is 8,000, less the accumulated depreciation so far, which is 1,600 minus 1,280 minus 1024. So that is 4096 times 20% times 9 divided by 12, because we're showing on 30th September. So we get 614. There's a 0.4, but I've ignored it. Good. So you have 8,000 minus 1,600 minus 1,280 minus 1024. That is 4096. So 4096 times 20% times 9 divided by 12. 9 divided by 12 because the asset was sold on 30th September at the end of the month. Good. So that gives us 614. Good. So now this disposal, we need to calculate all the depreciation that has been charged on this asset, that's accumulated depreciation on machine number one, and take it off the book. So disposal. So we say number one. So we have 1,600 plus 1,280 plus 1024 plus 614. So that is 4,518. 4,518. That's the total depreciation to date. Good. That'll be taken from the books. Then we go into our disposal accounts. Let's go into our disposal accounts. Good. So first, we credited the asset account with 8,000. So we have to come here. That's 2007. That's 30th of September. We have motor van. Worth what? 8,000. Then we have debited accumulated depreciation account or provision for depreciation account. So we come here, 30th of September, depreciation, accumulated depreciation. Provision for what? Depreciation. The provision for depreciation of what? 4,518. Now this will give us, by comparing the cost with the provision for depreciation, we are looking at the carrying amount of the asset. Okay, so let's see, 8,000 minus 4,518. Good. That gives us a carrying amount of 3,482. But we sold the machine number one for what? 2,290. Now, when on sale, okay, cash will be coming in. So we debit our cash account or our bank account, and we credit the disposal of motor van account. So on the same 30th September, that's when the sales was made, we have bank, and the amount we received was 2,290. 2,290. Okay, good. So now we need to determine whether there was a profit or loss made on disposal. So let's see. Obviously, it's a loss because when you determine the carrying amount, 8,000 minus 4,518 gives us 3,482. That's the carrying value of the asset. So if you don't sell it for anything, at least you must get our carrying value. Now we sold it for 2,290. It means that we've made a loss. Okay, so the carrying value is 3,482. The current value is 3,482, which is 8,000 minus 4,518. That gives us 3,482. So if you compare this with how much we got from the sale, which is 2,290, that results in a loss of that results in a loss of 1,192. 1,992. Okay, good. So that comes to our P&L. That comes to our P&L. So 2007, 30th September, we have depreciation of what? Depreciation of 614, depreciation of 614, and we have a loss of disposal. Same 30th September, we have disposal of 1,192. Good. Good. So we've accounted for the disposal. Now let's look at the other assets, number 2 to number 4. Let's look at number 2 to number 4. Now at the end of 2017, that's 31st of December, P&L for number 2. Now number 2 is 5,000 minus 1,000 minus 800. Let's see. Yes. Minus 1,000 minus 800 minus 640. Okay, that gives us 2560 times 20%. That gives us 512. So machine number 2, depreciation is 512. We take machine number 3. Number 3 was just acquired in 2006. So machine number 3 costed 9,000 minus the first depreciation, which is 900. That gives us 8,100 times 20%. This time around is a full year because it was used from the whole of 2017. Good. So the same 31st December P&L, number 3. Number 3 is 1,620. That is 9,000 minus 900 times 20%. Good. Then 31st again P&L, number 4. Now number 4 is 7,200. 7,200 minus the accumulated depreciation on number 4, which is 360. That gives us 6,840 times 20%. That gives us 1,000 368. 1,368. Okay. 1,000. Good. Good. So now let's continue. 512. 160. Good. So let's continue the accumulated depreciation. So now 31st December, uh, depreciation number 2, depreciation number 3, depreciation number 4. Number 4 is 1,368. This is 512. This 1,660. Good. Good. Okay. Good. So at the end of this year, let's see. We have 7604 plus 614 plus 512 plus 160 plus 1,368. That gives us 11,718. 11,718 minus 4,518. So our balance as of 31st of December, our balance carried down our accumulated depreciation is 7,200. But let me quickly reproduce our accumulated depreciation account somewhere here to make way for the we have 2007 as 30th of September of provision for depreciation of 508, same 30th of September of our bank of 2002-9. The loss for the period 1192. I'm just reproducing it here so that there will be a way for us to continue the accumulated depreciation account. Good. Good. So now I can clean this side. Okay. Okay. All right. So let's continue. So 2000 and, 2007 on 31st of December, our balance carried down. On our assets, we have 29,200 minus 8,000. That gives us 21,200. So 29,200 29,200. So of 2008 or 2008, our 1st of January balance brought forward is 21,200. Good. So we're told that number 2 was scrapped for 50 cedi on 30th June 2008. So on 30th of June, there was a disposal. That's number 2, machine number 2, and it was the value of machine number 2 was what? 5,000. Okay, so 5,000. Good. So we take the cost off the asset account. Okay, take the cost out of the asset account. Good. So let's see. Number 2 is 5,000, and it was used for 6 months. So we need to charge 6 months depreciation on that asset. So let's look at our accumulated depreciation account. So on the 2008, 1st of January, our balance brought forward the 7,200. Okay, so 30th of June, P&L, that's machine number 2. Let's look at it. So machine number 2 is 5,000 minus 1,000 minus minus 800 minus 640 minus 512. So that gives us 2048 times 20% times 6 divided by 12. That gives us 205. It's 204.8. 204.8. So I'll make it 205. Good. Good. So now we must take off the accumulated depreciation on this asset up to the date of disposal. So we have 1,000 plus 800 plus 640 plus 512 plus 205. So the total accumulated depreciation so far, so here we come here and say 30th of June, disposal. So this disposal, we are taking the accumulated depreciation on machine number 2 up to 30th June 2008. So we'll add 2004, 2005, 2006, 2007, plus the 2008 charge for the 6 months. We add it together and we take it off the provision for depreciation account or the accumulated depreciation account. Good. So 1,000 plus 800 plus 640 plus 512 plus 205. That gives me 3157. 3157. Good. So let's look at the disposal account. Let's look at the disposal account. Let's look at the disposal account. So 2008. 2008. So on the 30th of June, of motor van of 5,000. Then on 30th of June, of provision for depreciation of 3157, if I'm not mistaken. Yes, that's 3157. Good. Now they are saying that this was scrapped for what? 50. So on 30th of June, we have bank of 50. So uh, 5,000 minus 3,157. The current amount is 1,843. So if you are, the saleable value should at least have been 1,843, but we're told that it was scrapped. So it means that the difference, when you take the scrap out, and made a loss, made a loss, made a loss of 1,793. 1,793. 5,000. 5,000. Wait, wait. Great. So let's continue with the rest of the assets. So now, as of 31st December, PML number 3, 31st December, PML number 4. Good. So machine number 3 is 9,000 minus its accumulated depreciation. It was bought in 2006. So it was 900. 2007 was 1,620. So that gives me a carrying amount of 6,480 times 20%. That gives me 1,296. Pick machine number 4, which is 7,200 minus the first depreciation, which is 360, minus the second of 1,368. That gives me a current amount of 5,472 times 20%. That is 1,094.4. I'll keep it at 1094. Good. Good. So let's see. At the end of the period, 31st of December, our balance carried down. So see. So you have 7,200 plus 205 plus 1,296 plus 1094. That gives me 9,795. 9,795 minus 3,157. That gives me 6,638. That gives me 6,638. Great. So 2009, 1st of January, our balance brought forward 6,638. Good. Good. Now let's look at our asset account. So on the 31st of December, balance carried down. That is 21,200 minus 5,000. That is 16,200. So that's 21,200, 21,200. So 2009, 1st of January, balance brought forward 16,200. Good. Now in 2009, there were no transactions in 2009. So we'll end here. End here. Yeah. So let's look at uh, profit and loss account. So I've 614 plus 1 1192 plus 512 plus 1620 plus 1368. That's 5,306. Okay, 5,306. Okay, so that is the case. That is the case. That is the case. Let's look at the 2008 transactions. So 2008, we have 30th of June. We have 30th of June. A minute. Okay, so let's continue. Good. So we're looking at 2008. So 30th June, we have the depreciation on machine number 2. Machine number 2 for 205. Machine number 2 for 205. For 205. 205. 205. Then the disposal, is 30th of June, disposal of 1792. 1792. And as of 31st of December, 1st of December, depreciation on machine number 3. 31st December, depreciation on machine number 4. Machine number 3 was 1296. 1296. And this is 1094. That is 1094. Great. Good. So let's look at our profit and loss. The expenses for the period 205 plus 1792 plus 1296 plus 1094. That is 4387. 4387. 4387. Good. So that would be for 2008. Good. So as I indicated, we end here because in 2009 there were no transactions. Good. So this is how to account for non-current assets, particularly with emphasis on when an asset is disposed. When an asset is disposed. Good. Now, on the exam condition, you must also make sure that all your computation of your depreciation is shown. You must show clear computation of how to understand. That's why in my guidance, I make sure that whatever I'm doing, make sure that I put you in the know. Okay, good. So that is the end of this question. That's the end of this question. Let's quickly look at the last session. Let's look at the last session. lesson. Good. So the last session talks about disposal of property, plant, and equipment. That is part exchange of an old asset. Okay, part exchange of an old asset. Good. Now, what does it mean that an asset is disposed of through a part exchange of an old asset? Now, sometimes a supplier will agree to take an old asset in part exchange for the sale of a new asset. This practice is quite common, for example, with motor vehicles. A business entity may buy a new motor vehicle from a car dealer, and the car dealer will take an old motor vehicle in part exchange for the new one. This arrangement is known as trade-in. Thus, the business entity is said to be trading in the old vehicle. The business entity is said to be trading in the old vehicle, and the car dealer is said to be granting a trade-in allowance. It is not trading in, it is trading. Okay, it's trading in. The business entity is said to be trading in the old vehicle, and the car dealer is said to be granting a trade-in allowance. Good. Now, disposal of assets in part exchange for a new asset are accounted for in much the same way as disposal of property, plant, and equipment for cash. Okay, good, good. The only difference is that the disposal value of the old asset is the amount that the seller of the new asset allows in part exchange for the new assets. That the cost of the new asset is the full purchase price plus the double entry. Sorry, the cost of the new asset is the full purchase price, but the double entry is partly to bank, that is, or payable for cash payment, and partly to the disposal account for the old assets for the part exchange value. Okay, so we are saying that the cost of the asset is the full purchase price, but the double entry is partly to bank. Okay, it's partly to bank and partly to disposal accounts for the old assets. Okay, good. That's for the part exchange. Good. So let's look at this example, and then that brings us to the end of this session. Let's look at this question quickly. Good. So basically, this brings us to the end of this session. We've looked at part exchange of uh, Okay. So we're looking at the part exchange of a motor vehicle for a new one. So we're looking at S Limited. Okay. And we're told that S Limited has several cars that it recognizes or accounts for them as property, plant, and equipment. The cost of the assets as of the beginning of year 5 were given us to be 200, and the accumulated depreciation was also given to be 80. Then on 2nd January, S Limited bought a new car costing 50, but the car dealer accepted a car owned by S Limited in part exchange, and the part exchange value of this old vehicle was 4,000 Ghana cedis. This car, which was part exchanged for the new vehicle, originally cost 30, and its accumulated depreciation was 25,000. Good. And we're to show the gain or calculate the gain or loss on disposal of the old car. And B, we are to show how the purchase of the new car and the disposal of the old car will be recorded in the ledger account of S Limited. So this is what we did. So we have the disposal account here. We have the motor vehicle account, and we have the accumulated depreciation account. This will demonstrate how it will be recorded in the ledger account. So at the beginning of the year, motor vehicle account, the balance brought forward, that is the 200,000 we recorded. Then we also recorded the accumulated depreciation brought forward, that is 80. Then we move ahead to look at the disposal that was done. So if the motor vehicle costing 30 was part exchange, it means that that value needs to be taken off the motor vehicle account. So you see that disposal credited to motor vehicle account by 30. Then we came to the asset disposal account, came to debit it by 30 as well. Then the accumulated depreciation was also taken off the accumulated depreciation account. The total brought forward is 80, and the asset that was part exchange and the accumulated depreciation for that needs to be taken off the books. So that was debited to the accumulated depreciation account and credited to asset disposal account. Okay, good. Now, then we look at the part exchange. The part exchange. Now, assuming that asset was sold for 4,000, what would have been done is to debit bank 4,000 and credit the asset disposal account by 4,000. However, here the asset was exchanged for a new one. So what we did was to credit the asset disposal account in the name of motor vehicle 4,000 and debit the motor vehicle account in the name of asset disposal 4,000. That is to record the part exchange. Good. Then at the end of the day, we strike the difference on the asset disposal account, because when you take 25 from 30, then the carrying amount is 5,000. So if nothing at all, the asset should have been sold for 5,000, but we sold it, we exchanged it for a new vehicle for 4,000, meaning that will be a loss of 1,000 on the disposal. Okay, good. And in the motor vehicle account, the asset acquired was 50, not 4,000. So the difference will be paid in check or will be paid in cash. So that's the bank account of 46, added up to the 4,000 to make up the cost of the new asset of 50. Okay, then at the end of the day, you just need to close up the account as it's been demonstrated. Okay, good. So this is how a part exchange of a new asset, or when an asset is acquired through a part exchange of an old one, this is how the accounting entries will be accounted for. Good. Now, I'll end here, and then we continue our discussions later on. Okay, good. But before that, let's look at the let's look at the let's look at the PPE accounts. So once you have looked at accounting for PPE, okay, we need to know the schedule. Now, when we are preparing final accounts for the company, this is how we have to prepare our property, plants, and equipment, okay, or disclosure that is required to be made. Now, there should be a section for cost, okay, a section for cost, a section for depreciation, and when the total depreciation is deducted from the total cost, we get our net book value at the end. So this is how a typical PPE schedule looks like. It's been shifted. The figures have shifted. So this one should be here, this should be here, and this should be here as well. The same from this side. But then it's just to show you how a typical PPE schedule what looks like. Okay, good, 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 good. And certain disclosures that are also required. Okay. Now the financial statements shall disclose for each class of property, plant, and equipment the measurement basis used for determining the gross carrying amount, the depreciation methods, useful lives or depreciation rates, the gross carrying amount, and the accumulated depreciation, aggregated with accumulated impairment losses at the beginning and the end of the period, a reconciliation of the carrying amount at the beginning and the end of the period. So here we look at the additions, asset class as held for sale, among other things. So these are typical disclosure requirements of IAS 116. Good. And here too, I've given you some solved exam type questions that is just to comprehend your understanding of accounting for non-current assets. So this will be shared with you later on. And so we end here, then we continue our next session later on. So I still indulge you to keep on revising your notes, make use of the Institute manual, the number of questions in there, the question bank as well. So kindly go through them, and in our interactive session, we'll discuss in other questions. I'll try to address your questions on each of the topics that we've done so far, and we will take some exam type questions and solve it together. Okay, so do enjoy the rest of your day. Do enjoy the rest of